Okay.
to start that so we can record. All right, and we are good to go, Mike.
Hold on one moment. I'm getting texts and emails, and okay, I'm back. Okay, so thank you, everybody. My name is Mike Dovbish from Nutrition Capital Network. I'm executive director and have been with the organization since its founding in 2007. So it's good to see everybody on this webinar who's signed up, and folks are still coming on. This is a little bit new for us. Obviously, everyone's doing things a bit different these days. For our NCN applicants, we typically we receive applications on a rolling basis, and those applications are reviewed by our selection committee. We then accept companies to present at an upcoming NCN meeting. And then those applications are shared twice a year by our annual members. So they get to see all of your information twice a year. And whether you are invited to present, your information gets in front of them. And many times they will reach out to many of those companies that apply. What we're doing differently this year is because I know everyone is, there's a bit of urgency going on right now, and all of us want to be as helpful as we can. So we will be sharing your applications prior to July, which is when we share applications. It's July and January. So we'll be sharing those applications before our New York event. And we also wanted to provide a bit more service to all of you as much as we can, which is the reason why we're holding this webinar today with Elliot. Elliot is with the Intertwine Group. I'm going to have him introduce himself in just a moment, but I just wanted to thank you all for your interest in NCN, and also let you know that we have not made a final decision yet if we're going to be doing our usual spring investor meeting, which has been pushed to the end of June in New York. I think we were leaning towards still having it, but as time has gone on, as days have gone on, we are seriously considering doing a digital event whereas we would do 2, maybe 3 digital events where accepted companies would present in front of investors. But we'll be reaching out about details on that in our final decision soon. But in the meantime, I'm really pleased to have Elliot talk to all of you about what he's seeing on the front lines. I'm sure many of you have been experiencing what he's talking about, but because he talks and interacts with so many folks, whether it's brands like yourself or distributors, retailers, investors, I thought it'd be really good for him to speak to all of you more broadly. And then I think I sent to all of you a financing webinar put on by Naturally Bay Area, which will be tomorrow. And sometime today or tomorrow, I will ask each of you, feel free to email me directly if you then have specific questions about or requests for guidance that I can then see if our selection committee members might be able to respond back to you or set up a call with you to help you with your needs. So I think with that, we're ready to go, Elliot. So please go ahead, and we'll open this up a little bit later for Q&A.
Yeah, and I really want to make this, thanks, Mike, first of all, and I'll do an introduction, but just a couple of housekeeping things for everybody. All of you are on mute right now so that we're not hearing a bunch of ambient noise. So, but I've given you each the option of unmuting yourselves as needed, but I would ask that you try to remain on mute when you're not speaking. Also, the chat box is great for being able to ask questions, and we'll be monitoring that because I really want to make sure that this is responsive to what all of you are wondering and thinking about. And a lot of what I'm going to share is just acquired information. Everything that's happening right now is so incredibly fluid, and for every thought, there's a contradicting one out there in the marketplace. And so I really want to be mindful of that. And also, I don't, there's so many of these taking place right now and going on right now that it can be a bit overwhelming. It's kind of like drinking from a fire hose. Also, just one last housekeeping thing. If you do have a question that you want to ask live and not through the chat box, go ahead and there's an option under your participant to raise your hand, and it'll show me a screen that your hand is raised. Or like I said, you could just type in the chat box that you have a question. You don't even have to type the question, but just type "I have a question," and I will come to you, and you can unmute yourself and ask the question. That way we don't have anyone talking over another person trying to ask their questions in a mad dash. So a little bit about me for those that don't know me. There are plenty on this call that have the misfortune of knowing me. But I've been in this industry for 30 years, and TIG is a one-to-one customized accelerator really focused on trying to help emerging brands in the natural product space bridge that that gap that, unfortunately, for lack of a better term, is often referred to as the valley of death, that pre-seed to Series A and above, and to really help brands get to the point where they're self-sufficient, that they're able to attract the necessary capital and teams and move forward. And a big part of what we do and are involved in closely is what's happening from a capital standpoint and a funding standpoint, and what options exist out there today, and what's changed, as well as what other people are finding some success in or struggles with. So obviously, since this is something that Mike and I put together, and it's really was opened up primarily to those of you, in the NCN kind of stratosphere, a big part of what I'll share today is funding and funding related. But I'm also happy to talk about anything else, whether it's, channel strategy or team, etc. And then tomorrow on the webinar that Mike mentioned, we'll be doing, there'll be a broader group, so you won't have to listen to me nearly as much, but there'll be a broader group talking about everything from cash flow management to what the CARES Act and the SBA options are, to non-dilutive funding mechanisms, etc. So highly encourage you all, if you've not already, to register for that. So I'll start with kind of what we're seeing out there and what I'm being told. I know, and Mike, chime in too as to what you've heard, if there's anything different, or if you've heard things that are similar that you want to just reemphasize. But I've spent a lot of the last couple of weeks talking to investors, both angels and funds, and at a 20,000 kind of foot level, here's what I've learned. There's still money in the market, and there's still money that is ready to be deployed to help brands grow. Nothing has changed there. What has changed is the appetite for uncertainty. So with the uncertainty in the market, most investors are going to be more cautious about putting that money in unless there is some form of uncertainty premium, right? There's a recognition that things are just different than they were 3 and 4 weeks ago. It's also very difficult to pin value on a business and come up with good valuation. So raising capital is still possible, and it's actually many of our funders are telling us that they're actually planning to aggressively deploy that capital, but they're planning to do so with the right kind of deal and premium. So what does that mean for you? Well, it means a few things. I was on another webinar last week, and one of the guests made the statement, don't raise capital now. And that is a luxury that many on this call probably just don't have. So, I mean, if you don't need money, don't raise it. I mean, that's pretty good advice in any time. If you don't need the money, don't raise it. But if you need the money, don't be afraid to raise it. But think about it a little bit differently. And here's what I would encourage you to think through. First of all, I would encourage you, one, to get very, very intimate with your cash flow. Understand your cash flow on a day-to-day, week-to-week basis, because it is absolutely the predictor of your ability to be on the other side of this. Because it's easy to say you got to pay attention to that if you're on the side right now. Let me back up for a second. There's kind of a bifurcated impact that this is having on brands. There are those brands that are struggling. They were hoping to use Expo West and this year as a springboard to either launch in market, dramatically grow their distribution, or introduce new items, as well as raise around. Okay. And so those brands are hurting from cash inflow and opportunity on the revenue side. And then on the other side of that bifurcation are those brands that are either essentials or are in that kind of wellness and are having unprecedented sales. And they're seeing huge demand. But that too has a massive impact on cash flow, because growth is the most voracious consumer of cash. So the faster you grow, and the quicker that need to be able to absorb, finished goods inventories, receivables, et cetera, the more pressure that puts on cash. So regardless of what end of that bifurcation or that continuum you are on, both of them cause cash flow challenges. So starting with really deeply understanding your cash flow and where you stand there is critical, and understand your inflows and outflows. If you're going to raise, here's my recommendation. Stress test your model. Look at best case and worst case scenarios. Let your cash flow really tell you, and then determine what you need to get through the next 6 to 9 months. Okay, so this is no longer a raise to the next round or the next 2 or 3 years. In my opinion, it's a 6 to 9 month strategy that you should be focused on. And in that 6 to 9 month strategy, identify the cash that you need. Okay, once you clearly understand that capital, then let's first look at what alternative financing options are available. So certainly the CARES Act is an opportunity for everyone on this call. So there's still a lot of ambiguity around it. We're all trying ourselves to learn and get more familiar with it, but so are the banks. Tomorrow's call, there'll be 2 people who are really experts on it speaking to it, but I would identify what that means. And then non-dilutive forms of capital. So debt, looking for, your potential, funding, AR factoring, PO financing, inventory financing, things along those lines. I would encourage you, though, to kind of put a line of demarcation down in debt in terms of, how much you're willing to risk personally. Try not to sign personal guarantees if you don't have to. Look for validity guarantees, and just be cautious about doing anything that puts your future financial health or your ability to take care of yourself and your family at risk in these times. It's not worth going to that degree. So once you have that identified, if you're left with a nugget of cash that you need to bridge the next 6 to 9 months, that's the capital you're going to go raise in the form of equity. So the key there is, again, to recognize that if you're going to go to an investor, most investors who are sitting on the sidelines are going to deploy that capital if they feel they can have some type of premium, an uncertainty premium attached to that. And denying that or pretending that's not real is a disservice to you. I don't think I'm an optimist, and I'm a believer in the inherent goodness in most people. So I do not believe that most investors are going to be overtly predatory or anything along those lines. But you have to think from their perspective, and the fact that they're surrounded by even greater uncertainty than ever before, and you're asking them to deploy capital to you in a time where you have even greater uncertainty. So there should be a premium for taking on that risk. So that's why I say make that round smaller. So if you're investing, if you're looking from angel investment to VC, this strategy, it's the same. So let's talk about like a convertible note strategy. So if you've already raised a note, a friends and family round, a seed round, you could raise a bridge round, again, and you might have to set aside the terms of that in a way that is reflective of this current situation. So that means you might actually have a value cap that was lower than your last note or equal to your last note. It may mean that your discount rate is higher. It may mean your interest rate is higher. It may mean that you include follow-on rights or follow-on rights at a discount. You're going to have to be creative in those terms. I've talked to a few investors and asked them the question about if they were approached by founders and just said, hey, we recognize there's uncertainty in the market, and we recognize there needs to be a conversation, that builds in some premium in the investment to that uncertainty. Let's have a creative conversation around that solution. How would that be received? And while most investors said that would be received well, they're still ultimately looking for some anchor point from the brand in terms of where they think that should be. So I think thinking through that yourselves and where that works, and don't be afraid. I mean, again, if you're only focusing on the current needs, even if the terms of that particular convertible note are at a premium or quote unquote worse than your last round, it's only going to be effective and impact that amount of money that you're raising now. So it's only going to be dilutive to that rate. So you can understand it pretty clearly. If you're going to do a priced round, I think that's a different story, because you do then have to acknowledge, if you have on your cap stack, if you have notes that will convert at a qualified event, then you have that impact as well. So definitely this is the time to engage your attorney. Okay, so one qualifier here, I'm giving you just some business advice. It's not legal advice, and you should always spend the money and the time to talk to an attorney to make sure you understand the repercussions and the impacts of doing anything too creative in your terms, and the impact that they have on any existing notes or cap that you have on your table, and also any future. But you need to think differently. And then there's other alternatives. There's the growing advent of equity crowdfunding, which I am beginning myself to think differently about, because it does democratize the process, and there is the ability, if you're really good marketers and have brands that can build to it, to leverage it. And then there's other creative vehicles, which could be offering non-dilutive forms of investor opportunities, which include putting money in at some royalty, for example, and having a royalty payout that maxes out at some multiple against the initial principal put in. It's up to you to be creative in these solutions, but to know the implications of that creativity. So, but there's money there, and that's the key. And if you need it to survive, you got to go get it. And if you need it to survive, you need to understand and be willing to accept the premium of the uncertainty in it, and just go get what you need to get through. But I would highly recommend figuring on, after you stress test your model, on 6 to 9 months worth of needs, not 3 months or less. So,
Elliot, can I ask you a couple questions?
You certainly can, Mike.
Thank you. I want to go back to your point about uncertainty. Can you define a bit more about uncertainty here? So, when I think of uncertainty, there's a few things I think about. There could be uncertainty of maybe your product's selling really well now. Is that going to continue? What about if you have a certain type of product that's an immunity product that's going to do really well for another, let's say, 6 to 12 months, and then what happens after that? So what are the different types of uncertainty do you think investors are thinking about?
Well, I mean, I think uncertainty is uncertainty. I mean, in its simplest form, um, you know, I think let me step it back. Any investor investing in this space before all this happened was dealing with uncertainty. I mean, that's investing in startups is risk capital, period. So and the risk is unknown. That's what risk is. So it's the amount of uncertainty that's increased. So I think every brand carries with it a different degree of uncertainty. And again, so the upside brands that are seeing huge upside, how long does that upside last? What happens? Is there a trough or a cliff on the other side where it drops down? What happens to supply chain? Are you going to stress your supply chain? If this continues, are your suppliers going to your co-man's going to have to shut down, and then you're not going to have supply? All of those things are unknown. What's going to happen to employees? What happens to channel strategy if you're, in other channels, food service, college campus, corporate campus, travel? All of those are uncertainties that no one really has the ability to predict timing or impact. So,
Yeah, and what I've heard from investors, we had a call with our cornerstone investors, our annual paid investors that come to the meetings and receive materials from all the presenters, and it sounded like they are all still, like you said, they're out there. Before this happened, there was funds out there and strategics that wanting to invest, and that has not changed. What but tacking off your point about uncertainty, they're sort of thinking about, they'd like to start that, they're open to starting the process with talking to new companies, but it's going to take another month or so to sort of feel like there's a baseline. And it normally can take anywhere from 6 months to 12 months to close the transaction. When you first meet an investor, it could take a little longer, it could take a little shorter. Now, I would say you'd probably need to tack on another 3 months, because you sort of need to layer that in to get through the next month or so that there's some sort of feeling of, we're on the backside of the peak of all of this, and there seems to be some light at the end of the tunnel of all this. I don't think they need to feel like everything's behind us and we're running at 100%. They just want to feel like we are on the backside of this.
I agree with everything you just said. I mean, I do think that time works in favor of that uncertainty premium decreasing, because first of all, one thing about uncertainty is it's also psychological. So as we learn to live with more uncertainty, it becomes less palpable and less urgent. And I think the other thing that'll happen is over time is that there will be more clarity, and more clarity decreases uncertainty. So the longer you can extend that out, the better. And with passing time, as things get distilled down, that uncertainty premium drops. And I think the other thing you're spot on about in particular is that it's going to take more time, but to raise, but you can also help reduce that time by being better prepared. So really being clear on what you need and why you need it, stress testing your model and being able to articulate and show investors that very clearly, having all of your data room and due diligence ready to go, doing all of those things in advance to make that, to shrink down the things that usually just take more time to do it. And also understand from an empathy standpoint that they're uncomfortable too, and what you're asking them to do is frightening from an investor standpoint. So to whatever degree you can all acknowledge that as being a real emotion and show the steps that you're taking proactively to reduce that risk in any way, shape, or form, is really critical. So that means focusing on showing capital efficiency and reaching your consumers in new nimble ways, I think is really important. So
Yeah, and I think for our community, the NCN community, and our network of networks, these are not really going to be the folks that you can get really quick investment uh, capital from. They're going to take their time, and they're going to take a little bit more time to deploy their capital. So I want everybody to know that there are places you can go, and probably some other investor groups that could probably respond more quickly. But ours is typically in it to take a little bit more time on their due diligence. So I just wanted to give a heads up on that for those on the call. What kind of categories are you seeing out there that of interest? To investors, when I'm talking to companies, I'm seeing things across the board, from startup frozen pizzas that they can't manufacture enough right now, to immunity shots. We had a company that presented last fall. Um, they probably had less than a million in sales trailing 12 months, and they can't keep up with demand.
yeah.
So I think there are certain products that are doing really, really well. I don't know if a startup beverage brand right now, I think that would be more difficult. So I don't know if you want to comment a little bit more on maybe categories or products that are seem to be doing pretty well right now, and that are also easy to sell direct to consumer.
Yeah, so a couple things. Let me just go back to your comment around the speed in which investors invest, and especially your investors, and you know them very well. I'll say a couple things. An investor pulls the trigger very quickly is even though you need the money soon, is probably not an investor you want, because likely they're pulling the trigger either because they're negotiating terms that are so in their favor, that they're going to do it, and or they're emotional. And I will tell you, as a founder, the last thing you want is emotional investors, because that just becomes really, really challenging. So just know that usually the wise, sophisticated investors are patient. But one thing that I am encouraging you to do as you build this, we'll call it this apocalypse round type of mentality, with just that bridge amount to get you through, is do put a sense of urgency in terms of its close. So when you build those terms, you should feel okay confirming that, because you're building those terms and you are accepting a uncertainty premium in them, that your intent is to close this round in whatever time it is, 60 days, etc. And some investors will just self-select out of that, and that's okay, because it makes them uncomfortable to make a decision that quickly. But if that's what you need to do, build it in right away and communicate it. In terms of sectors, so I mean, anything immune or health and wellness is doing extraordinarily well right now, especially those that have the ability to easily transact e-com. Any business that is really e-com enabled is in a good position. Also, I think anything that is related to just overall personal well-being. So that could be stress management, that could be sleep management, that could be not killing your kid management. It could be any of those things are doing very well. And then on the brick and mortar side, obviously anything essential, same kind of categories. But the other reality is that, depending on sources, but if you look at like Technomic, something like almost 50% of our consumption was out of home. And if you think about the fact that that's, for the most part, other than, DoorDash and Grubhub is gone, it doesn't mean that we're all consuming 50% less. There are those of us who would really benefit from doing it, like me, but not one of them. We're just consuming them in the house, which means just by nature, every product in both retail and e-com that was serving, that was in-home consumption, has an opportunity to capture the sales that they were losing from out of home. So anything that's really built as a replacement. So convenience foods, frozen foods, things along those lines are doing very well. I think the things that are probably hurt the most, the sectors that are hurting the most right now, outside of those who have built business around food service or alternative channels, are immediate consumptions. So RTD beverages are hurting because people are making impulse shopping trips. They're making very planful shopping trips that are prescriptive in what they're getting. They're not stopping at, C-stores, drugstores, and they're not as mobile, and they're not, eating on the run. They're not, driving from one place to another in their cars and consuming food. So impulse items are definitely taking a hit to some degree.
I did
But
hear, though, I thought I read somewhere that as the weeks go on, folks are starting to go back into their list of their favorite chocolates that they used to buy and things like that. So now that the essentials are out of the way, they're
yeah,
sort of moving a little bit more towards that. Maybe not as much,
but I see those differently. So I'm talking about just true impulse items.
right.
A small bag of chips, a ready to drink beverage. But people are definitely, still wanting their comfort foods and their snack foods. So snacking is growing online super fast, by the way. So if you're a snack food brand, I saw Matt Perry from the Good Chris Company flip in from a little bit ago, and I mean those kind of brands are well positioned if they're both in brick and mortar and e-com enabled, because people are snacking, and
So they've got some sales, though, and some presence already before coming into this.
yeah.
Okay.
Yeah. So, but it's also an opportunity to message to it. I mean, people are I see a lot of articles. One of the things I try to watch is what's being talked about that's non-related directly to brands. So like this morning, so I do it like Google alerts, and it's kind of a fun, weird thing that I do, but I would encourage you guys to do it. But one of the things that I'm seeing just a massive increase on articles and blogs and things being published is around stress eating. So it's really interesting if you're starting to see a lot of stuff around stress eating. This is where you as a founder can be pretty nimble about messaging around how you can be an antidote to stress eating or a better choice for stress eaters, but acknowledging the empathy that people right now are eating emotionally, and it's an issue. So I try to watch things like that, because usually when you see an uptick about that, it's because it's resonating with people and consumers, and therefore there's usually opportunistic people and brands following behind it, messaging that they're the solution to that. So look for those kind of things that you can do, and put some Google alerts in on some topics that you feel your brand can speak to, and use those to speak to your brand. Hey, this article came out. So,
And are purchases being made through companies' own website, or is it mostly Amazon?
I don't know that we know if there's been a switch or any yet. I think it's too early. I think it's both. I think both websites and Amazon sales are up. I mean, Amazon sales, I think what I read the other day or heard, and then Betsy McGinn shared this with me, I think it's 62 or 63% of American households are now Prime. So that's massive penetration. So if you just think about it that way,
Yeah.
so if 63% of American households are Prime, then just by nature, Amazon is certainly has its claws into the vast majority of our consumers. And then the conversion rate there is very high. But a lot of people still like to buy, direct from the brands that they feel good about. And there's, a lot of things that can be done. And certainly when you're doing more on non-ambient product, refrigerated, frozen product, your website probably plays better, or places like Healthy Goodness or others. So
Good. Why don't we open it up to some questions? Do you want to do that through chat, or how do
well, I
we
mean,
want to do this?
there's a couple ways. So a couple of people have posted questions here in chat, which I can read. Or if you want to just type into the chat box that you have a question, I'll call on you and you can unmute yourself and you can just ask the question, so that you don't get stuck just listening to my voice or Mike's voice for the whole time. So here's one from Laura. It's as an early stage brand who's still building awareness, it'll take a significant dollar investment to acquire customers. While investors understand the dilemma of conserving cash and optimizing, online, so in other words, Laura, feel free to unmute just for clarifications. What you're saying is it takes a lot of money to create and acquire customers, and investors get that, but at the same time they're putting pressure on conserving cash and optimizing online. Do they work against each other?
Yeah, I mean, I think it's just getting your perspective from like the investor perspective. I think it's easy to say mobilize online. And I guess, I'm sorry, I was typing fast, so that didn't come across right. But to acquire customers online as a brand who has limited awareness is very expensive, right? So it takes a lot of capital to then create momentum online for early stage brands who haven't built the awareness of like, I don't shop for that item yet. So I don't know to say, oh, I'm missing it. Let me go online and find it. And I don't know how much people are discovering new products right now, like searching online for new products. So it's like just any advice on managing the conversation between conserving capital so that you're in this high risk time frame, right, where you want to make sure you make it to the other side, but I'm also want to be careful of over investing in something that won't yield the revenue returns needed to say that it worked, because it's an expensive proposition to acquire people online.
100%. That's a great question, and I'm so glad I asked you to say it out loud, because it makes more sense to me. Two things. One is I'm a big believer in the no bullshit rule. So, I mean, you need to tell investors and yourself that your number one objective right now is survival. So everything that you do should be built upon being around whenever the new normal comes. And I don't think the new normal is going to be that dramatically different, because we're so habitual by nature. I mean, I just think the good things that are working here in all of this will stick, and the things that we miss we'll go back to. So that's the number one objective. And every investor, who either has already invested in you or is contemplating investing in you, should know that that's what your focus is, because you can't show them a return if you're not there to show it. It's that simple. But then specifically around e-com, I hear everybody saying the same thing. And listen, I'm as guilty of it too. I've been talking to our brands and say, we've got to move more of our efforts to e-com and all of that. It is absolutely expensive, crazy expensive to do, acquisition if you try to do it broadly. But what I would recommend is a very, very small growth hack to prove traction. So in other words, don't spend to get everybody. Geofence, geo-target, and have a louder voice in a smaller market. Get really narrow on the consumer you're trying to activate, and just spend, it's the correlate, not the dollar. So in other words, if you can prove that you can get 10 customers spending X dollars, but you can show that if you spent 100 times that, you'd get 100 times the, you show that relationship, that's fine. And that's the way you should. You shouldn't, spend right now crazy growth money that you don't have. Survive, but experiment a little bit. Growth hack. Do some really small, narrow tests. It's also a great time to test messaging to see what plays, and go from there. So, what other questions do we have? Nancy. Okay, so Nancy said, how do investors look at debt? If we take on debt in order to get through the next few months, will that be looked upon negatively? It just depends on again, every investor is different, and all debt is not created equal. But in my opinion, the benefit of debt to an investor is that it's non-dilutive. If it's not, if you're not saddled by a massive debt service, that when you get growth capital, you're spending growth capital to service your debt. Most investors will look at it, as a necessary thing in a business. I mean, debt, in my overall philosophy, is debt should be leveraged for working capital, and equity should be used for growth capital. So it's okay to use debt to fund inventory, to fund accounts receivable, and most investors would rather see you use their money to fund marketing activities and consumer acquisition, or to build team, or for innovation, etc. So, but just make sure it's the right kind of debt and not, debt that saddles you with something that makes your business less operationally adept. What else? Any other questions? Keep throwing questions.
There was one above Laura.
Oh, that's right. So we had Michelle. We need angel investment capital to fund high volume production orders to keep our prices competitive with the bigger brands. But at the same time, I'm hearing that investors don't want to provide capital investment if brands are spending money on ads and low margin trials to acquire new customers. So how can we drive trial, advertise new customers digitally, but still attract investors to help us scale? So, I mean, this is a really complex, multi-layered question, but a few things I will say. Again, I would be leery to use too much of your investment dollars to fund production. So investigate fully options around PO financing, inventory financing, et cetera, where possible. And, that was tough before. It may get tougher now, but just make sure that you exhaust that as an option. It's a chicken and egg thing, because you want to be able to run the production runs at the levels you want to get the unit economics that you need. But it's still ultimately about cash. So I would start with the cash implications. What you might find out is, even if your COGS are higher and you run a smaller COGS run and still spend the money and invest the money on acquisition, that you're ahead from a cash standpoint than you would have been if you made a huge production run that had better economics, but it takes a long time to convert to cash. So I would look there. Secondarily, I don't think right now is the time to spend a lot of money on trial. Okay. And I know I'm talking somewhat out of two sides of my mouth, but certainly at retail, now is not the time to drive a trial strategy. It's just not going to be effective. People aren't treasure hunting like they used to. And so spending a lot of trade dollars right now doesn't make sense. And I would encourage anyone on this call to reevaluate their trade budget at retail and ratchet it down, because I just don't feel like you'll get the promotional lift, and you're spending money that probably does not need to be spent. Online, it just gets back to what I was saying to Laura before, and that is, just be precise and be experimental and narrow. You don't have to spend crazily, and just begin to prove it, because that's, investors invest in a growth hypothesis. Okay. And the better your growth hypothesis, the more investable it is. By that I mean, if you have really clearly defined assumptions and you can show proof that your assumptions are validated, that's ultimately what investors will invest in. They talk about the things like traction and top line and trailing 12 months and all of that. And so much of that, in my opinion, and listen, I'm a contrarian thinker, so I may be wrong here, but so much of that is really just investors trying to, one, figure out how to put a value on that investment, and two, is the way we choose as an industry to keep score. But at the end of the day, an investor is really, a savvy investor is really thinking it through, is investing in the hypothetical growth that a brand or product represents, and the degree to which you can de-risk or prove or validate the assumptions in that growth hypothesis, the better you are likely to win an investment. So when you look at those kind of things, don't look to grow, especially now, in my opinion, don't look to grow broadly or largely or make big jumps. Prove your hypothesis. If for example, if your e-com hypothesis is that, if we spend, an ACOS of X, or we have an acquisition cost of Y, we can get, this result. Well, just take those down in terms of the actual dollar amounts lower, and therefore then expect the lower return in revenue dollars, but the relationship should stay the same, especially if you narrow your target market, either geographically or demographically or socioeconomically. If you narrow those things down to validate those assumptions, you should be able to show the same correlation validate the assumptions in your hypothesis, and be able to take that back to investors and articulate it in a way that gives them a little bit more comfort in making the investment. So,
Thank you, Elliot.
welcome.
We have more questions. Oh, sorry, Michelle, did you want to add anything more?
Yeah, I did. Sorry, I'm like double muting.
You're good.
So
We can hear you.
basically, I just wanted to clarify, when you said no trial, I meant, like, you know how online they're saying like buy 3 bars, just pay shipping? That's what we meant by trial, like low margin trial. We don't make a ton of money, but it can help drive residual, ideally lifetime value of the customer. So that's what we were debating with as a acquisition strategy in this new digital space. But it's also trying to, at the same time, keep our margins high, which we're not making money on. So that's what I meant by it.
Yeah. So again, I personally think that setting a lot of trial vehicles right now is very difficult, because I think people are not, their shopping behaviors are disrupted right now. They're a little bit different. So I wouldn't go too crazy on trial. I would do more on messaging, and I also look to do more on any way you can do any type of joint or affiliate marketing would work. But just having a smaller pack size or a lower barrier to entry for trial, that's part of an e-com reality. I mean, if you're not going to get people to take big risks in buying something they've never tried, so you've got to have that in there and have that as part of your acquisition strategy. But again, if you're opening that up to everybody and people are just taking advantage of the trial because it's something cheap and they're just doing it, then it's kind of the spray and pray mentality. But if you narrow down that offer specifically to the consumers you're trying to attract, or then the geography you're trying to attract them, then you're being pinpointed, and you can really take a look at what the conversion rate is from that activity. So you can still have the same trial offer, just make it less often and make it more narrowly. So.
Right. Thank you. I want to address one question here about the SBA loans. There will be the webinar tomorrow. I think Keith Kohler has really gotten quite familiar with the SBA loans. He's going to be on that call tomorrow between 12 and 2 Pacific. We're also going to do an interview with him, so we're going to be posting that on newhope.com. But do you have anything you want to add to the?
No, that's exactly what I would say. I mean, Keith is really, he's amazingly in tune with this, and he's consuming this information, and anything that I would share is really probably coming from Keith anyways. So why not get it from the source?
We were supposed to publish his article last week, and then he just kept bumping it because of all the updates that were made. So he had to keep changing his article. So that'll come out soon. He'll be on the call tomorrow, and I can connect him with anybody on this call if you want to send me an email. I just want to comment on one or two of these about finding angel investors. I think at this point, if you are a small company, a startup, you really just have to focus in on your geographic area. If you are in Chicago, try to go through friends there. If your product's not, if you are in Chicago, let's say that's where your company is, and you're just starting out, investors outside of Chicago are, particularly this time, are not going to be interested. They are hunkered down. And in normal times, I would say it's hard to attract investors to companies that are just sold geographically, and if they don't have a strong online presence. They want to be able to go to their local market, see your product, meet with you. So I would just say focus on your geographic area, friends and family, your networks. It's going to be a really tough uphill climb outside of that. You want to add to that at all?
Yeah, it's probably the question, even under normal times, I get asked more than anything, is how do I find angels? And I mean, the reality is that most angel investors maybe make 1, maybe 2 investments in the year. And then those that are really kind of in the industry, the true angel investors in the industry, they're inundated. I talked to a couple. I mean, one of them, who we all would know, I mean, he gets like 2 decks a day. So, and
Yeah.
he maybe makes 3 investments a year. So
And we have, I just want to add one thing. We do have many angel investors that are on our NCN selection committee that show up to the events, but they'll invest in companies that, have at least some revenue or some presence out there. But otherwise they're dedicated to this industry. And they too won't make that many investments. So.
Yeah. So, I mean, my suggestion with angels is that every brand has its own set of angels. I mean, it's people who are either going to believe in, first of all, you, second of all, what you're doing, who are aligned with your mission, who are fans of your product. I mean, there's, and I won't name him because he's on the call, but we had, a brand that had somebody who just reached out in love with the product and works for, in a very high ranked position for a big company. And, that's a potential angel, and you should reach out to those people in that way. So you should be building your own angel networks, getting to know people in your own geography. I mean, that includes getting to know people who manage money in those geographies. I mean, networking is still the best way to raise angel dollars.
Yeah. And I just want to add too that there are the Naturally Network. There's the Naturally Network, the large umbrella organization that just formed, and then all the affiliates out there. And so while right now the events are being held virtually, you can still connect and network with folks on these webinars. There'll be time for Q&A, so you can connect with people that way. But that's going to be, I think, where you just need to focus is on your own area and friends and colleagues.
I mean, there was one question here about, angel lists and so forth. I mean, angel lists, guys, they're all beneficial. Also, most geographies have many angel groups, and you can look on the Angel Association in your geography and find angel groups and apply. There is an industry angel group it's at wearetheangels.com. It's the angel group. It's CPG, natural products focused. You can apply there. But any of those tend to see a lot of deals and a lot of deal flow. They may not be, the angel groups geography may not be natural products or CPG focused or even comfortable or understand. So you're going to need to shake your own tree and create your own angels. And I would really, really look towards doing that and communicating it and reaching out. I mean, certainly you want to connect with all the angels that are known angels in this space and who make investments in this space. But when you meet with anybody, first of all, the other thing that I don't think enough people do is make it really clear to anyone and everybody in your network that you're raising money. So make sure that you do. I mean, including on your LinkedIn headline, we are raising a convertible note round. We are raising a seed round, whatever it is. Make sure that everybody knows that you're doing, so that they have the opportunity, because the people that believe in what you're doing and believe in you will invest. And I do think, there is I'm not going to lie, there is a funding gap, and that gap's been growing over the last few years. And, the VCs, even the VCs that were willing to do seed investments, have moved up market because the funds have gotten bigger, and economically it just makes more sense for them to make, just a fewer number of larger investments, because it takes just as much time to go through the process. And so the gap has gotten larger between friends and family and a Series A round. And so you're going to have to be more creative. And I also think that a good source is, it's time not to discount or diminish the potential of equity crowdfunding, because it may be, if you don't have a very established network, if you don't have the time, it may be a very viable way to raise the money that you need to bridge. So
that was great. Let's see, I'm trying to think. What was the name? We Are the Angels?
Yeah, we are the
.com?
angels.com. I think Ted
Okay.
put it up there.
Oh yeah, I see. Okay, good. Let's see. I'm trying
And
to see if
that's a group of people in the industry that understand the space, that are, they've come together as an angel group to make investments. But again, and I'm part of that group, but we're not making a lot of investments. So
good. Are there any other questions out there for Elliot? Anything else? Any other?
Somebody's sharing their screen by mistake here. You might want to turn that off.
They are, yeah. Any other closing thoughts, Elliot, for the group?
No, I mean, I think the key thing here is to make sure that you're doing what you can to survive, and really understanding what needs to happen to get you to the next place in this time, is to get you out to the other side. And so, I'd be spending a lot of time, again, really working my cash flow statement and understanding that, and also really working on understanding the amount of money that I need to bridge, and then being creative around that and reaching out to people and networking. And lastly, I would say, if there, again, there's two things you can be doing, and they seem diametrically opposed. So the first is to be looking for opportunity amidst the chaos. So right now, you're entrepreneurs. Everyone on this call is an entrepreneur. So look for opportunity in there. So, how can you shift, adjust? Where is there maybe, a way to reach consumers that you weren't reaching? I mean, for example, I was talking to somebody in the social media D2C space today, and she said that, social searches and interaction are up dramatically, but spend is way down right now. So that, there are search terms and pay-per-click terms and things like that that are lower cost today than they were before. So maybe now's the time to try to do some of that. So look for the opportunity amidst the chaos, and at the same time is don't just worry about growth for the sake of growth. Too many CPG brands do that, and they worry about just consistently pushing top line and showing year-over-year growth and improvement in their trailing 12 months. Your number one objective needs to be to get to the other side, to survive. So any discretionary spending that you don't have to make, anything that's high bet, high risk that you don't have to do, don't do it. So
Yeah, and I just wanted to add another thing too, is, I know all of you are working really hard trying to sell product and connect with investors. And I think if you're feeling some frustration, if you're trying to connect with investors, sometimes the answer is just what the answer is. And if they are not interested right now, or if it's not a fit, or they don't, the check size is, they write larger checks, that's just what it is. And then you have to move on. So I think a lot of companies that I interact with, I do feel that some of them they want things to be different. They want this fund to act differently in how they invest. And unfortunately, that's just not how it is for the most part. So it's better just to cut your losses in time and move on. Keep them updated, but move on.
Yeah.
And I think probably, Elliot, you'd agree.
I couldn't agree more, Mike. I mean, I look at it as not a no, as a maybe, or later, or not now. But the other thing that I think that I would just add to that is, when you get that answer, say, terrific. Who are 5 people you can introduce me to that might be interested in talking with me? I mean, push them. I mean, a lot of times they actually feel bad about saying no. So leverage
That's a great point.
That
great
guilt
point.
and say, please, can you make 5 introductions for me? And by the way, whenever you ask anyone to do that, make it super easy for them. Write a paragraph, or 50, a sentence, 50, or 50 words. Here, if you could just copy and paste this and send it, it'd be so appreciative to 5 people. Because if you leave it to them to have to think about what to put in the introduction, it just sits on the back burner. But
Yeah,
people walk away from an investor meeting without making that ask.
yeah, and I couldn't agree more on that. You make it really easy for all your connections to say, send them a separate email, very clear, very specific, and ask them to make an intro or whatever you're having them do. But make it, but don't put the onus on them. Once, if you do that, 99% of the time, it'll just go to their trash. So just make it super easy, and they'll want to help. People, everyone wants to help right now. They want everybody else, though, that they interact with, that comes to them, to think ahead and make it easier for them to help.
And if they do help, take some time to appreciate the help. I mean, one of the nicest things you could do if somebody's willing to do that for you is send them a personal note, just a handwritten note. Thank you for the help. Thank you. I mean, again, one is just being a good citizen, and appreciative. But the other thing is that every investor that says no today is really just saying not now. And so you want to cultivate that relationship, because, later on, if you've done it well and you've done right by them and you stay top of mind, then they may be willing to invest. And especially if you go the extra mile to acknowledge and appreciate whatever help you can get. So.
Great. Well, hopefully we'll have you back on again.
Anytime.
Okay.
Depends what the reaction is. I might get voted off the island, Mike. You never know. So.
Well, listen, good luck to everybody out there. I know it's a difficult time. Be safe. And please let me know if you have any other further questions. You can email me directly. You can email Elliot. And I hope you can all join the webinar tomorrow. I think it'll be really, really helpful to everybody. So thanks again, and we'll all be in touch.
Yeah, one just really quick point. I am more than happy to help if there is a way I can do or make a connection for you or anything along those lines. Please feel free to reach out. Just give me a little time to respond. But I feel like now it's incumbent upon those of us who've been the beneficiaries of being in this industry and having built nice careers here to be able to turn around and support you in these kind of periods of time right now. So it'd be my pleasure to help, and don't feel bashful or reluctant to reach out.
Great. Thanks, everybody.
Okay. Take care.
Thanks, Elliot.
Bye-bye.
Bye-bye.